Hello, everybody.
There you go. All right. The first thing we're going to do this week, guys, and I added this at the last minute. I felt like that unemployment number was pretty, jobless claim number was definitely worth talking about. So initial jobless claims fell to 184,000 in the weekend of December 4th, which is the lowest level since September 1969.
Nice.
Not nice, Michael.
The prior week's level was about that. All right, so we still don't have like a universally accepted answer at what's going on here. How you could have jobless claims hit a 50-year low and have this situation still with so much unemployment, just generally speaking, and people not filing and not seeming to like need something to do. So we try to explain this, I think, through the prism of entrepreneurship. Is that enough, or is there more to it than that?
I think it's just people that were, tertiarily involved in the job market.
That's not a real word. Okay, I know exactly what you mean, but it's definitely not.
If you say it with enough confidence, it's a word.
Tertiarily. Okay.
They were involved. They were in the job market prior to the pandemic. Now there are people that are no longer on, the typical roles. And we talked about this for years about Uber and all of these, kind of ride sharing. I think that there are more and more people that have either left the workforce entirely because they haven't been able to replicate, or they don't want to replicate what they were doing prior to the pandemic because it was some sort of services job that didn't allow them, really any upward mobility. Or we've gotten to the point where maybe that baby boom, we talked about all of these retirees. Did they really just retire and they're like, I'm not going back? Because the participation rate is still lower than it was prior to the pandemic, and there's really no movement there. But the unemployment rates across different demographics have improved. So it's not like you can still point to just like women aren't going back, or I just think that a bunch of people. But
how are we going to sell magazine articles if we don't say exactly who's not going back?
Like, there's 3 million people that drive for DoorDash now. Where do they come from? Like,
what were they doing? What were they doing 2 years ago?
And I also here's another thing.
Ben, isn't like 90% of them part time?
That's what I mean. So do they have a few part-time gigs? So they do Uber and DoorDash and Lyft, and
they're just not W-2, and they're never going to be.
Did you read Derek's piece on the Great Formation? I didn't, but I imagine you did, because he was talking about this.
Well, you also have like the total quits in the U.S. right now is 4 million people, and so people are probably just in between. I think, is it possible? I'm a Jerome Powell stan, and I stand with the U.S. government.
Know that.
Take coming.
By the way,
take coming.
Very confident in my assertions.
That's you.
I made it on the board. Is it possible that all these surveys are just really screwed up right now, and the unemployment picture has never been as weird as it is right now?
This chart is permanently broken.
Yes.
These are initial jobless claims going back 50 years. It is this chart is now garbage. Look what the pandemic did to this chart.
It's completely meaningless. You have to adjust that by not including last year.
Honestly, how do we take this out?
So you have people coming into the labor market and going out of it in their part-time jobs, and they're stopping to watch their kids. There's all these different moving parts. Is it possible that it's harder to track this stuff right now, and all this stuff is going to wash out like a year? And
we have to measure it differently.
Really happened.
We have to get a different data source than what we used to use.
Yeah, like what?
Shadow stats.
No, like maybe how much money is flowing into people's bank accounts is what they want to do. They want to start tracking deposits into bank accounts. I don't know if they'll be able to, but
that seems
the IRS wants to do that. Maybe that's the right data source. People have money coming in from somewhere.
Is that invasive?
Of course, it's invasive. I don't want it, but like if you have people not on W-2 and that's what they're tracking, if you have millions of people who will never be W-2 ever again, then how are we ever going to fix what we think the measurement is? I don't have an answer. Rhetorical question. What do you got on this?
I think there's inefficiency in the data gathering too. I mean, there's not enough jobs of the people that are supposed to be gathering the data to be able to get good data. So that's why we're getting all these revisions. I mean,
that's not a high enough paying job. Data gathering for unemployment.
I don't think so. But it's also people that was their second and third job. That picking up those second and third jobs. That's where we've lost like a lot of folks.
You know where we're losing people? We're losing people to Bitcoin. There's 16,000 people with over $5 million.
Yeah, you're lost in the metaverse.
This guy's fucking gone.
There's 16,000 people that have $5 million in Bitcoin that are never coming back to the job
Michael's
market.
answer to every question I'm going to ask today is Bitcoin. I'm just giving you that. I'm giving you that stuff.
I'm talking about those people in the mall with the clipboard, and you're talking about crypto billionaires.
Yeah, surely there must be a crypto-related answer to
right?
this.
Am I right?
You must be. I can't imagine it any other way. All right, earnings growth. Who put this in the doc? Is
I
this
did.
you?
I did.
What's going on here?
I'll tell you what's going on.
John, do we have this chart? Last decade real earnings growth?
There's a few things going on.
Okay. Go ahead.
All right. So what we're looking at is earnings growth by decade going back to the Civil War. And look at this chart.
Wait,
No, I'm kidding. It's earnings growth by decade going back to the 1900s.
Who was collecting the data in the Civil War, please?
Yeah, I'm kidding.
By horseback from town to town.
So the point is, the past decade, 2010 to 2020, was the best annualized real earnings growth for the U.S. stock market since 1870.
really?
How about that?
It's almost as if the rally has been justified all along.
That really surprised
John,
me.
put my chart of the one with dividends and earnings growth on there. I'm going to skip ahead here a little bit to show you because people hate good news.
No, they hate a stock market rally that's justified by good news.
John Bogle has this equation where he says returns are dividend yield plus earnings growth, and then the difference or the delta, right, is the change in PE. So look at for the 2010s. Look at that earnings growth.
Earnings growth for the 2010s decade.
So this is what we're going to talk about. It was
10.6%.
The annual returns were all earnings growth, very little multiple expansion, right?
So PE change was plus 1%.
That's it.
So earnings growth was 10.6. So annual returns worked out to 13.6%.
And this is a little bit of like a backfill of an equation. It's that the PE is just a filler, basically.
Look at the 50s. 3.9% earnings growth, which is very poor. 9% PE change.
Because earnings
20% annual
because
returns.
the PE was depressed, obviously, after World War II.
Right. Okay. So that makes sense.
So this is a good chart to dovetail into what Ben was just talking about. Let's throw up the valuation chart, Big John. So Urian Timmer, who does amazing work for Fidelity, tweeted, earnings have done all the heavy lifting for more than a year now. The combination of slowing but positive earnings growth and a sideways to down PE multiple suggests a flattening out of the bull market slope. So what we're looking at, guys, for people that can't see this, listen to the podcast, is the S&P 500 over time rising, obviously. But for the better part of the last year and a half, the PE multiple has gone sideways to down, which is a good thing. That stocks are going up despite the fact that the multiple is compressing. It's all earnings growth. This is good.
The thing that's so funny is though how many people think it is the opposite.
Right.
How many people
They think it's all multiple expansion.
their narrative is that the Fed is driving multiple expansion,
Right.
And we're showing literally it's the opposite over the last how long? 18 months.
Shannon, weigh in.
But it's not, I mean, but I think this is even more concerning, right? Because if we're actually knowing it's not multiple expansion. Because
Where
of
is the
that,
multiple expansion?
Like, where is the multiple expansion? I mean, if we have earnings that are doing this well, they're probably not going to grow at the same pace.
Good point.
Because if you think about also what's been driving those earnings growth and those businesses that have been driving that earnings growth, are they going to do quite as well?
Well, yeah,
in the
to your
next
point,
few years?
it's. I mean, isn't the earnings growth all spending from the government, basically?
Not all. Well, over the last year and a half, yeah, a lot of it.
I mean, this one period.
So, all right. So then now you're in a situation where you've probably seen some of the best earnings growth you're ever going to see. Then you have to make a bet on multiple expansion. Is that the point? Like, how else do stocks go higher?
Well, yeah, if you think that they're going to go higher, you have to be counting on that. And then you have to start to get down to what is going to drive that multiple expansion if we've had all this good news. Michael, to your point, and we haven't seen multiple expansion. What's going to get us there in the next 2 years?
What's interesting is the next chart, which is breaking down 2021 equity return decomposition. I know nobody could see this, but it's a similar chart to what we're showing. So all the way on the left, we've got the U.S. You see the total return with a black dot, kind of hard to see. You've got the earnings growth, and then you've got the PE multiple contracting a little bit.
All right, so wait a minute. 30% earnings growth for the U.S. and negative
Multiple.
on the multiple.
Right. But look at other areas of the world. Like look at Europe.
This is universal. This is across every.
So Europe, but Europe and Japan like crushed. The multiple was crushed. Even with and look at the earnings growth in Europe and Japan. 40%.
So don't you
and
think
multiples contract.
Japanese
multiples
stock market had a 30% multiple compression this year.
So isn't this the like I'm defending the Fed here again?
Shocking.
Everyone always talks about, well, it's low interest rates and it's the Fed that is causing stocks to rise. Why aren't stocks rising more in Europe and Japan if they're doing this? They're spending just as much money and the rates are lower than ours.
They need a better Fed chairman.
Yeah, they need a Fed chairman that wants to focus on more multiple expansion.
The transmission isn't as effective there because there's no fiscal policy boost as well. I mean, if you go back to 2011, the reason why all that Fed accommodation, which obviously is dwarfed now with what we've seen in 2020, but there was a huge amount of accommodation in 2009 by the Fed, and then Washington didn't do anything, so you don't get that. And I think that's why, you're not really seeing, I mean, the Japanese haven't played ball in years from the fiscal perspective.
Can we also
either.
say there's not as many psychos in Europe and Japan as we have our gambling spirit, right?
We also have an equity mentality here.
Yeah.
Yes, they're more about real estate and saving, and we're about gambling.
Who
They're
we
more
talking?
about society.
We were talking. I think we were talking to Jay. His family's in Spain or something.
Jay?
Yeah.
Oh, Tenny.
Yeah. I think he was explaining something about how retirees in Europe, they know exactly how many dollars they have to spend each week. And that's just how they are in retirement. They're not betting on the stock market.
No, we're all about play to earn in the stock market in these United States, right?
Well, I think there's just more of a mentality anything can happen. And then you have people that are retirees in other countries, and they're kind of like, nope, this is what I have, and this is what's going to be coming in, and this is how I live based on that. So there's some element to that. What's this?
Skip this. Let's move on to expected returns.
Okay, what do we got here?
Ben?
This is from Vanguard, and they gave expected returns for U.S. equities and value and growth and REITs and all these different, and they also projected their inflation. So this is for the next 10 years, and this is not GMO, who's been predicting low expected returns for a while now, for a decade.
Forever.
Vanguard has been pretty reasonable with their expected returns. These are really low. So that's U.S. equities, 2.3 to 4.3%. That's nominal,
Wait,
not
Ben,
real.
this is their expectation for the next 10 years?
10 years.
Look at
So average annual returns
Annual
over 10
returns.
years.
And these are
US growth?
nominal.
US growth.
Growth is negative.
oof.
Value is a little higher
So this is a function of the current valuation.
and much higher in developed, ex-US.
Okay, so Vanguard is putting out there that they think U.S. equities will do something between 2.5% and 4.5% for the next 10 years.
Nominal.
With 16.7% volatility. That's not a good.
And they say, and again, Vanguard has been pretty constructive on returns of late. Now, I wanted to put what is the previous 10 been, just to show this. And this might, so I used all Vanguard funds here. So the U.S. stock market has done 16%. This is surprising. What do you think value has done without looking? Annualized returns over the
11.
last 10 years.
Last 10 years?
11, 12?
13.5.
13
People
and a
think value is dead.
Yeah.
13.5 is pretty damn good.
International stocks have done 7. Value, which everyone has just been stomping on its grave, is up 13%. Growth is up 19% per year. That's why it's all relative. So small claps are up 14% per year. REITs are up
Small
11.
claps.
What is here's a small clap. What is the difference between the way Vanguard thinks about expected returns versus GMO?
Did you read this piece? I didn't read it yet.
Vanguard GMO does mean reversion.
Yeah.
It's going to come back to this PE ratio.
And profit margins?
Yeah, I think Vanguard is more in the Bogle camp where it's dividend yield, earnings growth, that sort of, then PE.
So they're less, go ahead.
No, I was just going to say, if they're looking at dividend growth, then that's obviously why you get that delta between global and the U.S. because
Much higher
dividend
yield,
policy
yeah.
has completely changed for U.S. companies.
European stocks are yielding 4.5, 5.
Right. Are they incorporating shareholder yield, or are they thinking about buybacks? Because we're gonna have $1 trillion in buybacks this year and probably next year.
I think they only look at dividend, actual cash flow through dividend policy, right? I could be wrong about that. You would know better than I
I've
would.
been expecting low returns for 5 years. So
Well, a lot of people have, but yeah, no one is positioned for this, obviously. But don't you think so? I put out some analogies, where we are right now. Everything feels good, but you have people who've had experiences in the market that could go. I'm one of 3 ways here, which is what people are thinking. So you have some people say we're going to the 70s. It's going to be stagflation, high inflation. Other people say, wait a minute, I see this big tech boom coming over the next decade, and it's kind of like we had the 80s boom that led into the 90s. And then other people saying, no, wait, this is 2000 euphoria, it's coming to an end, right? I feel like any path you want to take right now or put out there for the market scenario historically, you could make a good case right now.
Well, there's just no way of knowing what will be the things that influence consumer behavior in the coming decade. Because if you were thinking in the early 90s, you didn't know that mobile phones and the internet were going to come along within 5 years. You had no way of knowing. Nobody knew. Mark Andreessen didn't know, and he was working on it. So you don't know what will be occupying our time and attention and dollars 5 years from now.
what if the metaverse adds $8 trillion in market cap to U.S. equities? Then what?
What if?
What if the metaverse sucks money out of everything else, like services and goods, and then you're in a completely that's cannibalized.
What if we have a Great Depression because everybody is running around with bunny ears and a rocket pack on their computer screen, and they just can't get out of the metaverse? Like I feel as though.
Did we talk about Lawnmower Man, a la the metaverse, a few months ago? One time.
I wasn't me.
Awful
I know.
movie.
I'm.
Awful movie.
I'm familiar with the film.
Wouldn't 6 to 7% annual returns in the U.S. in 2 to 3% inflation?
I take that.
Wouldn't that be the one that everyone is kind of wrong on?
Yeah.
It's like, oh, okay, it's just kind of boring.
Yeah.
The path to get there probably wouldn't be boring though, right? You'd probably still have a boom bust and then end up there if you look back on 10 years. If you consider like some of the things that went on with let's just say drug discovery, it's very clear that we're going to have a different path toward developing medicine post-pandemic versus pre. What if all of a sudden that's the next boom? And
mRNA?
the smartest people in the economy working on that, and there being a ton of money to be made. Like we just don't. I just feel very strongly that we really have no idea.
In that scenario, the boomers live an extra 20 years. The millennials are all pissed because they don't get their inheritance, and we riot in the streets.
Boomers living an extra 20 years. What does that do to allocations? More stocks. Every path leads to higher stocks. I think is the important.
Pretty much. I think we all agree.
I think we all agree on that. What is it? What is this chart with all the rainbow colors? I can't say
Ben,
it.
is this you?
What is this?
Who did this?
Oh, that's me.
Shannon.
Shannon, what do we got here?
There you go.
So I had a conversation with somebody this week, and they were telling me how they were not interested in the international markets because they were still excited about like the cyclical exposure in the S&P 500 and how we were going to see this cyclical rotation and the true value rotation was going to to
Then buy in.
Then why aren't you buying international stocks?
Do you have clients who are just throwing their hands up and saying, "Why do we own these? Why do we own foreign stocks?"
For years.
Yeah.
For years. But the point is that the argument was around why they were defending being underweight international with this cyclical argument about the fact that we are seeing this value rotation. And I was like, you're making my point for me. I don't even have to do this.
You're right. You're not going to get the full benefit of it if you're just U.S. stocks.
If you're just U.S. stocks. And it's going to be, if you actually think that this is going to accelerate through the second half of next year, you're going to be killed in the S&P 500 as it rotates.
This is the IFA sector weights you're showing?
This is the IFA sector weights. So it's 17% financials, 16% industrials. Tech is less than 10% of the IFA.
That's unbelievable to me. Still, after all this time,
You could easily make the case that we are in the early innings of the growth to value rotation.
Well, if we were sitting here talking in 2006, we'd be all talking about how dead the U.S. stock market was. And if I look at this and you're telling me this cyclical rebound is here and it can persist and sustain for a couple of years, I don't know why you're not in Europe, regardless of the growth situation.
Do we need the dollar to fall too? It seems like the period of falling dollar is always good for international stocks. Is that like a prerequisite, or do you think that just helps like as a tailwind?
It's generally a tailwind because I think if you look at like local returns versus net in USD returns, there's obviously something happening there from that perspective. But I don't actually think, like I've been asked, do I have to have a weak dollar outlook to be an international? No, I just think I need to look at this sector chart and just buy the index and benefit from, potential increasing rate, continued outsized inflation scenario.
And nobody's positioned for multiple expansion in international stocks because it's been so long.
Because one of the problems is that emerging markets are such a basket case. You're not going to get this cyclical upturn that you want if China remains in the state that it's in. It has never happened in like modern time. So it like even Europe benefits from trading with China. Like China has to believe me, we're not gonna arrive at the answer today. It's just hard for me to accept this idea of materials and industrials outperforming if EM remains the way it is. Do I have that somewhat right, do you think?
No, I think that's the case. And I also think that then you go back to, well, where does the economic growth that would need to drive investor appetite and interest in Europe? You got to have the rest of the economy globally has to be firing on all cylinders because they're not doing anything pro-growth in the European Union whatsoever. And I'm sorry, the Brexit situation in the UK, I mean, they can't even get trucks.
Yeah.
So I think it's going to be a few years.
The Germans have to be able to sell shit to China or else take that whole cyclical value rotation off the table. Like at least as a long-term thing.
Well, during the height of the trade war in 2018 and 2019, people got really excited about Europe because they're like, great, we're going to have this expanded trading relationship with China because we thought China was going to keep growing 2-3x of the rest of the world from a GDP perspective. Now they're putting the brakes on and saying, we might do 5, but it's probably going to be more like 4. That nobody gets excited about 4% growth.
Are you guys surprised that they haven't taken any of those tariffs off in a higher inflation environment?
They haven't?
Have they? Not really, right?
No, his policy is essentially the same. And
that seems like a layup to me. Why wouldn't you say we can immediately help inflation by taking these tariffs off?
There was an article, I think it was Musk, right? He was talking about graphite for the SpaceX. And there's still a huge tariff on graphite. And he was saying, you got to pull this off because exactly what you're saying, my input costs are so high. Like, why do we still have all these tariffs on? I think it's a political hot potato. I think if Biden can just stay out of it, he doesn't. It is what it is.
But some of these tariffs sunset, so I feel like they are going to come. Some of them will come off automatically, or
there's a group of them that should.
Right.
But I think there's some contingencies on that phase 1 deal too, which they're clearly not meeting. China.
Yeah. So Biden can't do it because politically it's not a good look. And we all know that anything that happens in China, it really takes a while to understand what the market implications might be.
I was kind of blown away by how angry people are getting with inflation. So I thought, like, you pull the easy levers that you can say, like, I can point to this and say, we're relieving cost pressures where we can because people hate inflation. They hate it.
He's at 57% disapprove of Joe Biden, and almost all of that, if it's not related to crime, it's related to inflation. Like, these are the two things that he's going to get hammered on.
Why doesn't he do a U.S. dollar buyback?
What do you want to? All right, so I think this is a good segue to international stocks sucking. To credit-driven asset price inflation.
What do we got here?
Did you guys read this thing from Verdad? I thought it was pretty well done. Basically, here, let me go through this really.
I didn't read it. Let me do it right now. I'll read it right now.
Yeah, read it right now while I read it. Here's the TLDR. Credit is extremely cheap and extremely accessible. That is driving rising asset prices in 3 key markets: public equity, private equity, and housing. In each of these markets, rising asset prices are accompanied by decreasing loan-to-value ratios, falling debt costs, and most strikingly, asset prices that look extremely high relative to history. So he's making the point that now you have both risks at once. You have like a lot of lending with low covenants, and you have very, very high prices.
Cool.
And his point is the Scylla and Charybdis of investing are bankruptcy risk and overvaluation risk. When credit fuels rising valuations, investors should be doubly concerned. It's not a great starting point for 2022.
Josh, you're like the Greek tragedy guy. What is Scylla and Charybdis?
So during the Odyssey, during that voyage,
I knew he would know this.
During that voyage, there's a narrow sea lane they have to get through. On one side is one monster. I forget. I feel like Scylla was like a sea monster, and then Charybdis is this whirlpool that sucks boats in. I have this. Shannon knows this shit too. Classically educated.
That's right.
I went to liberal arts school and I know nothing about it.
Regional high school, baby.
No, but you're from New England. They like really educate people still there.
They do. They do try.
Josh was classically trained at Jones Beach.
That's right.
Can I do a quick verbal meme here though?
Please.
Regular Winnie the Pooh, prices are rising. Winnie the Pooh in a tuxedo, asset price inflation.
Winnie the Pooh in a tuxedo with a monocle, Scylla and Charybdis.
Okay, but don't you think that low interest rates paper over all of this? I know that's kind of what they're saying, but
well, they have, yes, but forever.
How do
rates
rates rise?
Rates are never going up. Do you agree with this?
Yeah, they look at if you look at the spreads right now, it's actually hard for the Fed to raise rates that much anyway, even where we are right now.
The Fed's not going to invert the curve on purpose.
No,
right?
Josh was saying he's consensus.
I really am.
Josh thinks there's going to be 3 rate hikes next year.
Yeah, I do.
Do you believe that he thinks 75 basis points for the Fed funds rate next year?
Because I'm bullish.
Then I think they raise, and then I think they
3
stop.
times.
Yeah, I think two or three,
I
think they stop.
Really? What did they get to last time? What did they get to last time?
Do you have like a really big Fed outlook here?
2.25?
I really do.
You're contrarian on this one.
I've got a Fed outlook, guys.
75 basis points is not is not really hiking.
To me,
rates.
that sounds like 75 million basis points. I don't think they're going to do it.
But are they just raising them so they can
Lower.
drop them again?
for the next
Yes,
emergency.
but that's exactly why they did it before.
So let's get it over with. Just keep them low.
Yeah, why were they?
They're going to raise
why were they
them.
raising rates
the
last
market's,
time?
The market's going to vomit, and they're going to lower them.
They're gonna accelerate the taper, and then they're gonna get to the point where now they're like, oh, we've tapered, so we have to raise rates. Meanwhile, inflation's gonna be coming down because the only thing that's gonna be sticky is wages, and then all of a sudden it's gonna be like, oh, we did it twice, and look what we did. Prices are coming down, and then they'll stop.
How important is having a view on where Fed funds rates could go in the next year, let's say, to the way that you're talking about allocating portfolios? It's not important at all, right?
It's
you
not
can't-
that important because
you can't predict it.
yeah.
No. Of course you can't. Of course you can't predict it. Let's say you could. How much would it really change in terms of your return expectations for a portfolio?
It's not going to change my return expectations. And the way I look at it is that you're really keyed on client liquidity. Like, do they need liquidity? And so even if they're not going to, if they're going to make really poor returns in bonds, if I know that they need money in liquid form that is not going to move in value, they're probably going to be in short duration bonds, regardless of what I think.
Yeah, it's duration is the risk there, right? Is that if
Right. 3 rate hikes is not going to change how much you're allocating to bonds. The decision point on bonds is like, how much do I need to have not at risk for whatever my client
also
needs
to Ben's
to do?
point, if it's a year, it's under a year duration, then no, it's not going to matter.
and if you're holding shorter term bonds, rising rates are a good thing because you
Right.
can then reinvest at higher rates.
Right.
You'll never make money otherwise if rates don't go up.
Yeah, you need them to rise a little bit eventually.
Okay. Let's get into this Vanguard thing. So
Oh.
this surprised me. I guess probably because I'm not paying close attention. Vanguard Total Stock Market Index Fund is $1.3 trillion. It is now accounts for 10% of all assets in U.S. stock mutual funds and ETFs.
That's crazy.
In the whole market. Did you think it was this big?
I didn't think it was this big, but like backing it up, I can see how it could be this big because I think I see enough pension plan like schools and stuff, and this is always the mainstay of their every retirement plan.
So if you want to know why there's $3 trillion in Apple, this goes kind of a long way toward explaining how
All
that could happen.
Like people talk about it, and I include us in this, people, is speculating and Robinhood traders. Look at this. This is amazing. This is like, give me an applause on this. This is awesome. Like,
it really is.
right?
Because this is the opposite of that narrative that everyone's behaving like a maniac.
Yes, this is the everyone is actually investing like in a reasonable way. A lot of money's going into this, and maybe people are speculating on the side.
So what's funny is the second largest fund is the Vanguard S&P 500, $821 billion, which we can only assume will ultimately end up at $1 trillion. It's not going to take much.
But isn't that the bigger risk for when we talk about like speculating on retirement money? You know, the bigger risk is that people start to have to speculate on retirement money because stuff like this, when we get if we get a bad growth rotation, right, out of tech stocks, and you go back to the Janus Fund nightmare of 2000, 2001, right. This is where the concern is because this is safe money. This is a big index. I don't have to worry about it, but people don't understand that there's things in the dynamic. If we're shifting in the next year, in the next 10 years, those first couple of years are going to be painful for people potentially in this bucket.
Right.
But I think that's why we have speculation in retirement, not because we're different than the Europeans, but because there's so many underfunded retirements in this country that I think people feel the need to speculate.
Balchun has tweeted that Vanguard is at $300 billion on ETF flows, which is so we could potentially be at 350
this year.
Yeah, we could potentially be at 350. Right? It's early December. The previous record was last year, 200 billion. It's 300 already this year.
And Vanguard took in $300 billion in a year.
So do you think that like the bad part about this could be getting back to your growth and value thing? This is really growth heavy now. Like the total stock market and the S&P is very growth heavy.
Well, it is. The 5 or 25%.
But do you think that those big companies, Amazon, Apple, are they even growth anymore? Or are they just like in their own category now? Is it really like
they're like sovereign nations?
That's what I'm saying. Is it your stand? Like, could you have all these other growth stocks that are already getting pummeled, and these other big stocks are they their own?
That happened
now?
this week when the growth stocks were getting murdered. Apple's making all-time highs.
Yeah, I feel like people are like obsessing over the growth trade. These stocks are not moving with Adobe and Shopify. Like Apple and Microsoft are not doing what actual growth stocks are doing. they almost seem as though people feel more confident in Tim Cook than they do in Joe Biden. And money is just going into.
Well, it depends how you slice growth stocks. Are you talking about growth stocks that are losing money, like those type of growth stocks?
No, the next 50 down after the top 5
by market cap.
Yeah,
yeah.
So
these are in a class of their own.
They are not acting like these.
You don't think Apple can get cut in half?
No, I don't.
Come on.
No, I really don't. I really don't.
I think 20 to 30%. I kind of agree with Josh. In half?
No fucking
It's
way.
$2.9 trillion.
You have to tell me a story then why all of the liquidity sloshing around in the world suddenly disappears.
Aliens. I don't know.
Okay, fine. So
if we get aliens, you know how much infrastructure we're going to be spending on?
Yeah.
If we get
blow the
aliens,
White House up?
the Fed is going to juice this so hard. Aliens will be bullish.
If we get aliens, we're going to get a whole new round of stimulus.
Yeah.
I can't imagine a scenario. So of course it's going to start happening tomorrow, where Apple, Microsoft, Alphabet get cut in half, absent a massive recession. I can't picture it. And the reason why I can't picture it is because what we've basically done in this country is we've tied everybody's retirement to the stock market. And these are the biggest, most profitable companies in the world.
Well, I agree.
And the largest components of the stock market.
It's not going to happen for no reason.
It's going to have to be something
extraordinary,
so shocking.
Yeah.
What did these stocks do last March?
They fell 30.
Did they?
Apple fell 30.
Amazon was down 20 maybe.
Yeah,
I'll
not
check.
as much. But to that point, also the folks that have made total market index the biggest holding from a retirement perspective, they're not changing their mind over the next 2 years.
That's true.
So it's to your point, like Apple's going to sit where it sits because those funds are going to sit where they sit, and the construction of those retirement portfolios isn't going to change overnight. And so we probably can weather if it's like a rate storm because there's a growth scare. But I don't disagree with you. I look at
Apple fell 31.
I hate talking about tech because I think that there are clearly two camps and people talk about them as one big group. And I couldn't disagree more in constructing a portfolio that way.
So what's so interesting to me, I meet people and they're like, what do I do? Should I buy Apple? Should I buy Amazon? And I'm like, you own so much Amazon.
Right.
You own so much Apple. If you have a 401k and a 529 plan for each of your kids, you have tons of exposure to Apple.
Well, we were just talking before this. A lot of people now own the NASDAQ 100 as well. They view that as like a core holding. 50% of that fund is in the top 5 companies. So that's even more overweight to those companies. Do you think, so if we're like you're talking about why these stocks could fall, I don't know if I'm coining this myself, but like let's look at a white swan, like a risk we can see.
Okay.
Is the white swan out there just that like inflation goes away and the Fed raises rates to 1 or 2%? Is that the only like risk we can see that you could see really bringing the stock market down 20% for a bear market?
What's a reason that everybody agrees would drop the stock market 20%? Yes.
Oh, no,
the Fed gets
think
very aggressive.
The Fed, that's a layup.
Like that's the only one though, right?
That could easily
that's
happen.
his point.
Could easily
These are
happen.
layups.
So last year,
It's a white swan.
Apple and Microsoft Apple, Microsoft, and Google each fell around 30. Amazon only fell 22. Pretty amazing.
Here's a scenario where Apple get cut in half. We're not
regulation.
We're not sending any dignitaries to the Olympics in
something
Beijing.
with China.
What if China says, "Oh yeah, how about no fucking Apple iPhones in China?" And I wouldn't put that past. Like, if they wanted to put a lot of pressure on the average American, they could start screwing with some of our corporations that need China. Now, fortunately, Apple seems to be the most exposed to China of the FANG names, right? It's not important to Amazon. Alphabet's not even there. Facebook's not even there. If they decided, you know what, all this money that we're making because of Apple, let's just get rid of them or let's put pressure on them, I could see a scenario where Apple falls a lot. So that is is that a white swan? I guess because it's like it's in plain sight that they could retaliate in some way that really hurts the stock market. You hurt the stock market bad enough, you hurt the sitting president.
Well, it's not just consuming, it's supplying, right? If they just decide, like, we're not selling to any of these U.S. companies anymore, we're not giving you our rare earth metals, the China thing to me is a much bigger kind of long-term concern because I think that it's going to raise costs. I think that there's going to be this continued diplomatic tiptoeing that's going to happen. That's going to transcend, to my point about whether it's Trump or Biden, it's going to transcend all of these administrations.
Yeah.
Because they don't they're really looking inward now. This is an entirely different Chinese government than it was 10 years ago.
There are so many gigantic companies in the indexes that are so reliant on China for their future growth expectations. Just take 3: Disney, Nike, and Tesla. So taking Apple out of the picture, if you understand where they're saying that their future profits are going to come from, and you look at the infrastructure that they've built in China, and you look at like how much focus has gone into selling into that massive economy, if the diplomatic situation gets materially worse, you absolutely could make a bear case for U.S. multinational stocks. And those multinational stocks right now comprise like almost half the index. So I agree with you on the white swan idea. That's hiding in plain sight.
If
Like,
I can't get a new
everyone knows
iPhone,
about
that's
it.
like World War III then. We go to war for that, right?
Well, you can't make them here. You're going to buy a $40,000 iPhone? So,
You know what doesn't have Chinese risk? Bitcoin.
see, I knew it would come back to that. And you're absolutely right. I would give up my iPhone for a stack of Bitcoin. Why not?